This episode will provide an overview of the statement of cash flows. The statement of cash flows is an important financial report because it explains the change in the company's cash balance from the beginning of the period to the end of the period being reported. This statement reports what types of activities the company engaged in that generated cash inflows and what types of activities the company engaged in that used cash or created or caused cash outflows. This is important to report this type of information because users of the financial reports, such as investors, creditors, other companies, all of them need to know how the business funded its operations. It's healthy for a company to fund its operations from normal day-to-day activities as opposed to borrowing money, issuing stock, and those type of things. This helps answer the question, does the business have sufficient cash to pay its debts as they mature? It also reports to investors whether the company is making any cash dividend payments. And it also reports whether the business borrowed funds or repaid any loans during the period. This statement breaks down all of the company's activities into three types: operating activities, investing activities, and financing activities. Operating activities are the normal day-to-day activities that a company engages in through the selling of inventory or selling of a service to customers, receiving cash payments from customers, incurring expenses, paying those expenses, etc. For example, cash inflows reported in this section would include cash receipts from customers, cash dividends received from investments in other companies that the business may have, receiving interest from borrowers or those they may have loaned money to. Outflows would be cash spent for salaries and wages, cash paid to suppliers, cash paid for taxes and fines, and any interest that is paid to those who may have loaned the company money. Investing activities are the type of activities that generate or use cash related to the company investing, such as the selling or purchasing of long-term productive assets. What we mean by long-term productive assets are property, plant, and equipment that the company obtains or sells that was used in the operations of the company to generate and earn revenues. This will also involve the selling of investments or purchasing investments, either through selling of common stock or purchasing common stock of another company, or purchasing bonds or debt of another company. This can also involve the collection of principal on loans that were made. In other words, somebody that the company had loaned money to is paying back the amount that they had borrowed. And finally, the other type of activity that we generate or use cash within a company are financing activities. Within this section of the statement of cash flows, it would report cash inflows from a company selling its own equity securities, in other words, selling its own common stock, issuing bonds payable or notes payable, and issuing other types of short and long-term debt or liabilities. Outflows would involve the company paying dividends on its own stock, purchasing some of its own stock back off of the market in the form of treasury stock, repaying any cash loans that the company may have taken, and paying owner withdrawals if it is a partnership or a sole proprietorship. In addition to these three sections in the statement of cash flows, where these different types of cash inflows resulting from different types of activities are reported, there is a fourth and kind of a footnote type disclosure on the statement of cash flows, where investing and financing activities that did not involve the exchange of cash are reported. For example, the retirement of debt by issuing equity securities. A company may pay off amounts it owes by issuing its own common stock. There was no exchange of cash, but it is very important to report this because this would not have been reported within the main part of the statement of cash flows. However, investors or creditors may need to know whether the company is using stock to pay off debt. We would also see the conversion of preferred stock to common stock reported within this non-cash investing and financing activities section, or the purchasing of equipment by issuing stock or debt. Again, these would impact the ownership of the company for existing stockholders, so it's important to report these and disclose it within the statement of cash flows to ensure full disclosure.